Hello, everyone, and welcome to episode 30 of JustDario Cigar Time. I'm deeply grateful for your continued support. It's hard to believe we have been at this for 30 weeks, working to bring you the best insight, analysis, and perspectives to navigate the markets. My goal is always to help you approach the current environment as objectively as possible, and it's not going to change. That said, the situation is growing increasingly complex with each passing week. And this upcoming week is likely to take that complexity up a notch. Why? Not primarily because of the developments between Israel and Iran, though I wouldn't dismiss those entirely, as they could lead to disruptive geopolitical events. However, the real focus this week will be two major events scheduled for Tuesday and Wednesday: the interest rate decisions from the Bank of Japan and the Federal Reserve. Let's start with the Bank of Japan, which has been notably active in recent weeks, seemingly intent on sowing confusion in the markets. You might think it's obvious what monetary policy the Bank of Japan should pursue, but they appear to be doing the exact opposite. On one hand, they have promised to slow the pace of Japanese government bond purchases, but on the other hand, they continue to print money. As I highlighted in a previous episode, there has been a significant development on the government front in Japan. It's clear that officials are managing optics with the ultimate goals of keeping interest rates as low as possible. This is critical because neither Japan nor the global financial system can handle JGB yields, especially on the longer end of the curve, rising much higher than current levels. Rising JGB yields is a double-edged sword. Domestically, this will strain Japan's financial system. Internationally, these create problems because for years, investors have borrowed Japanese yen at near zero cost, assuming the exchange rate with the US dollar will remain stable for a long time. They used this cheap leverage to invest in assets abroad, not just stocks, but a wide range of assets, with the bulk going into fixed income securities. Now, because of the high yield environment in the US, these fixed income assets are trading at values well below par. This is why JGB yields must stay as low as possible. If funding pressures increase and the returns from these assets can keep up, the investors face a squeeze. Many of these transactions are hedged with transparency swaps, which are meant to net out cash flows and provide a risk-free transfer of capital across regions, assuming everything remains stable. But stability is eroding. Investors are facing a worst-case scenario. The cost of funding their transactions, including hedging, is rising, while the value of their assets is falling. Furthermore, the proceeds from these fixed income assets are now often lower than what's needed to cover the cost of leverage. Let's break it down with a simple example. Not long ago, US interest rates were around 2%. Investors holding long-term fixed income assets were earning coupons of 2 to 2.5%, okay? Now, same investors are facing funding costs in JPY that after swaps equate to around 4%. This mismatch is exactly what's happening, is exactly what's squeezing investors, but yet many fail to grasp its severity. This is why there is such an intense focus, not just from the Bank of Japan, but from a chain that starts with the Federal Reserve and ends with the Bank of Japan. And the focus is on keeping rising yields in check. Central banks are, in one way or another, printing money to achieve this. In Japan, the government can no longer hide the fact that inflation is hitting the economy hard. The Prime Minister has publicly acknowledged that people must learn to live with higher and rising interest rates. This was such an unprecedented statement for Japan economy. This is where the Bank of Japan is expected to provide some clarity, right? However, I don't anticipate government Ueda offering much transparency. Why? Keeping the narrative vague allows traders to chase the story they prefer. Some will believe the Bank of Japan is tightening monetary policy, while others will assume liquidity will remain abundant and rates will stay low. The result? Of course, kicking the can down the road once again. How long can this continue? I've noticed that the frequency and scale of the Bank of Japan's so-called temporary interventions in the open market are increasing at an alarming pace. One striking pattern is the need for these interventions every Friday afternoon before Japan markets close. This suggests significant imbalances and liquidity gaps that the Bank of Japan must fill to maintain orderly market function. Gaps that are clearly tied to what happens in US markets on Friday and potentially over the weekend. This growing sense of risk is straining traders' risk metrics, which are flashing loud warnings about the need for increased capital heading into these windows. Capital and liquidity that traders have less and less. Henceforth, the Bank of Japan is increasingly forced to step in to compensate. So, on Tuesday, the Bank of Japan will likely aim to make their decision a non-event. However, if anything unexpected is said, I wouldn't be surprised to see significant market moves. Even a small shift in perception, whether toward tightening or continued easing, could create ripples, not just in bonds, but also in the JPY currency markets. And this will usher the Federal Reserve's FOMC meeting, which once again is likely to be a non-event. Why? As I explained in my recent article, the Fed has painted itself into a corner with virtually no room left to maneuver. All it can do now is extend and pretend everything is fine until a clear market-driven event forces its hand. So, what kind of event could push the Fed to act? Don't worry, it won't be pressure from Donald Trump calling for sharp rate cuts. The Fed operates independently of the administration. And the Chair Powell has repeatedly shown he doesn't need the Trump administration demand. Ironic, given Trump appointed him. Instead, I see two potential catalysts. First, as Jamie Dimon has warned, there is a growing risk of a sudden credit event that could cause massive disruption in the financial system. In the US alone, banks are sitting on $400 billion in unrealized losses just due to higher interest rates. Credit spreads are at historic lows, though. Liquidity is abundant, and banks have been piling up toxic loans on their books, extending and pretending all is well. Why? Because as long as they aren't forced to mark these assets to market, they can keep operating as everything is fine. Never forget, banks don't fail due to insolvency alone. They fail due to liquidity crisis. A bank can remain insolvent for a long time. And right now, many banks' balance sheets, even large ones like Bank of America or UBS or Norinchukin, show signs of virtual insolvency. However, they continue to function thanks to accounting maneuvers and, of course, abundant liquidity. If a major US lender, such as Bank of America, were to face a crisis, the Fed would be forced to act. I warned about this scenario in a past article, suggesting that we should prepare for a BTFP 2.0, a new version of the Bank Term Funding Program, to bail out large lenders this time. The original BTFP helped banks dodge a bullet 2 years ago, but their underlying issues remained. The second catalyst that could force Fed hands could be even more disruptive. Inflation. Official US inflation data are so clearly understated that they are barely worth discussing. However, the strain on the US dollar is undeniable. With inflation underreported and yields artificially suppressed through Treasury buyback programs that are so obviously a form of yield curve control, the pressure is building. And where is it releasing? Primarily on the US dollar. The dollar is now at multi-year lows against a basket of currencies. As a country heavily reliant on imported goods, the US faces a dangerous mix: a depreciating dollar, proposed tariffs, abundant liquidity, and ample credit. This is a perfect recipe for a runaway inflation. Don't worry, we haven't seen it yet, but it wouldn't take much to trigger a panic among traders, potentially leading to a scenario reminiscent of the 1970s. I don't know whether many people remember that in the 70s, gold prices quadrupled in a single year, and interest rates quickly soared to 18%. It was chaos until Paul Volcker stepped in, raised interest rates aggressively, and set the stage for the 1987 market crash. We're not there yet, but the parallels are striking. Geopolitical instability, like the Israel-Iran tensions, is almost a sideshow for traders. Markets are so disconnected from the real economy that only a few factors matter: trends, momentum, liquidity, and leverage. Keep these four always in mind. Any significant move from central banks will likely be forced upon them, not initiated proactively. Central banks have never been proactive, and they are even less so now. Why? The Fed and other central banks, despite years of flawed economic forecasts and policies that inflated massive bubbles to prevent a systemic collapse, still prioritize their credibility. That credibility is eroding, yes, but it's still strong among traders. They won't make tough decisions unless absolutely forced to. And when that happens, the outcome won't benefit the entire market, as I described. A decision that supports the economy will likely hurt banks and the financial system, and vice versa. Personally, I expect them to prioritize preserving the global financial system over the real economy, because from that will always depend the whole construct of modern fiat currencies. Thank you all for listening today. I truly appreciate your likes, comments, and subscriptions on my channel, as well as your support on X and you reading my articles on JustDario.com. I wish everyone a great week ahead.